Hello, everybody. We're back with another episode of Pure Perspectives. It is Monday, April 27th. I don't know how it's already the end of April, but we're here. I'm with Gary. Gary, how you doing?
Good. What's going on, Clark?
Not much. I'm in Cali. He's in Texas. We're here to talk about mortgage stuff.
Mm-hmm. Mm-hmm.
Today, we're going to talk about a topic that has been hanging around since kind of shortly after the pandemic, and that is the lock-in effect of these ultra low rates that people were able to take advantage of during the
Yep.
pandemic, and how that has been limiting or holding back the housing market because they've been sitting on these low rates. They don't want to move. It
Yeah.
sounds like that's starting to thaw a little bit. And we're seeing people saying, hey, you know what? Maybe the high fives, low sixes isn't the end of the world. I'm ready to jump back in. Are we seeing that now? What are the numbers saying?
Yeah, absolutely. I think you hit the nail on the head. Thawing is a good word, right?
Yep.
Instead of this isn't kind of like, everybody's trading in their rates and they're moving on to a new property. But as life happens, life
Yep.
changes. The good side is families grow and they need bigger homes and they want to go to a different school and you have a relocation for a great job and you do that. And then obviously there's the negative side of things and divorce and things like that. But excuse me, people have reasons to move. And
Yep.
you're starting to see that, right? Like it's like every 5 to 7 years, folks usually move anyways. And we're starting to see that. So, in 2024, the data showed about almost 23% of homes were financed under 3%. Today it's 20. Going into that 3 to 4% category, 35% of homes were financed, 3 to 4%, and then down to today at around 31%. So, four basis points in change is a pretty substantial number.
Sure
It
is.
might not look like it in paper, but it definitely is in terms of numbers of homes, and you're starting to see that. And part of that is, for all the reasons, but I think, the market has become a little bit more, there is opportunity for people where
Mhm.
they're not paying, we're not seeing the 20% increase in property values, right? And so, yeah. So to your point, 100% thawing of the lock-in effect is starting to happen.
And then the other side of that coin is obviously people leveraging their equity for, high interest
Mm-hmm.
debt, right? So, yeah, you're sitting on a
Yeah.
3% mortgage, but let's just say, you have $50,000 in credit card debt. 5%, high fives, low sixes on a cash out refi to eliminate that debt is a very, very, very simple math when you start looking
Mm-hmm.
at cash flow.
Yeah, yeah. And we're seeing it. We see, a lot of different reasons. Sometimes, it's, hey, we're going to access the equity to buy an investment property. I just had a
Yep.
conversation today with some folks that are working on that right now. They've got one investment property. We're doing a DSCR loan for them today. They've got free and clear on their house, going to access a line of credit to get to the next investment. And so it's just people, using, that the house hack kind of cliche
Yep.
is out there, but using their properties to generate long-term wealth, right? Like this isn't, hey, I'm getting rich tomorrow. It's a long-term plan investment that, and we work with these folks all the time on this, and we always talk about your mortgage plan. It's important whether it's your first home or your 50th home. Like you got to have a plan in place. You got to know how the math works in your favor or against you.
Yeah, I'd say the real successful investors that are out there are really using their primary home as a financial tool, right? They're using the equity to
Yeah.
either acquire more properties, whether that be fix and flip, or as Gary mentioned,
Hmm.
DSCR kind of investment property, whether that be short or long term. So,
Yeah.
whether it be debt consolidation, eliminating credit card debt, wanting to buy an investment property, wanting to buy whatever, I
Hmm.
think to Gary's point on the mortgage plan, let's look at the numbers. I think the aha moment seems to be the initial sticker shock is the three going from 3% to call it six and an eighth, whatever. That's the
Yeah.
initial sticker shock. But when you lay it
Yeah.
out and you say, all right, this is what your monthly payments are now on high interest, whether it be credit card, whatever, and you start to see
Hmm.
the impact on cash flow, that is a very meaningful difference on a monthly basis. So I think people
Yeah.
are now that sticker shock's not as great, and they're like, well, hey, if I need to do this and leverage this, it saves me a ton of money in the long.
Yeah, absolutely. Yeah, it's you see it now more than ever, folks being more creative, whether it's
Yep.
their personal property or, a rental investment, what they're trying to do. And so, I think that's the side that we get excited about, or at least I do, working with folks to put a plan together. And a lot of times these are 6-month conversations. We're not like, this company wasn't built on slamming deals in just to get deals across the finish line. We're there to be very consultative, understand the client, understand their goals, and then give them the vehicle to get there via the right loan product. And I think that's important to remember for clients, is that you got to have multiple, like this client, we've done DSCR, primary, we've done a fix and flip, and so it's like they've used like every club in the bag that we've got, they're using it, and they're building on this portfolio. And this has been 3 years running now. And now they're going to be, including, this is their 3rd property right now. And we're looking at a purchase on their 4th in the next 2 to 3 months, once we get all these other ones figured out. So,
well, I mean, I think it's safe to say they must be consuming our content.
They know.
I mean,
can see it.
What you just described sounds like they've been going through our library of content, and they're just like a
hitting
sponge.
That subscribe button, hitting the like button.
They're hitting the like button. They're like, wow, these guys here, they're just a
drop the comment below.
Drop a comment. They're dropping comments. They're out there. They're moving
DMs.
They got the alert on for when we publish a new video. They are just waiting, bated breath for our next.
They can't wait. They're ready to go.
Awesome. Well, good update. We'll keep you posted. Not a lot of movement on rates. I mean, we're still kind of in this ebb and flow of
6 1/8. I think is what I saw today on a 20% down.
Not a lot of movement. Not expecting a lot of movement. So we are where we are. But get in touch. Get your mortgage plan together, and we will be back next week with another update. Gary, as always, appreciate it. We'll talk soon.
Man. Adios.
Take care. Bye-bye.